Today, we're diving into the wild world of economics. Now, I know what you're thinking, economics can be a bit dry and boring, but stick with me because we're going to make it interesting. We're talking about interest rates. Yes, those little percentages that can make a big difference in your financial life. Think of it like this. Interest is the price of money. It's what you pay to borrow money and what you earn when you save it. When you borrow money, you pay interest. It's like a rental fee for using someone else's money. Imagine renting a car. You pay a fee for the privilege of driving it around. It's the same with money. You're borrowing something valuable, so you gotta pay up. This is why loans and credit cards come with interest rates. On the flip side, when you save money, you earn interest. Think of it as a reward for letting the bank use your money for a while. The bank is basically paying you for the privilege of using your hard-earned cash. It's like they're renting your money to lend it to someone else. So, when you see that small percentage on your savings account, that's the bank saying, "Thank you for letting us use your money." See? Not so complicated, right? Interest rates are just the cost of borrowing money or the reward for saving it. Now, these interest rates go up and down like a roller coaster. They can be influenced by a variety of factors, including economic conditions, inflation, and central bank policies. Sometimes they're high, sometimes they're low. When interest rates are high, borrowing money becomes more expensive, but saving money becomes more rewarding. And guess what? Those ups and downs can seriously impact your life, whether you realize it or not. High interest rates can mean higher mortgage payments, more expensive car loans, and even higher credit card bills. Understanding how interest rates work can help you make better financial decisions and prepare for the future. So stay tuned, and let's navigate this financial roller coaster together. Let's talk inflation. You know that annoying thing where everything seems to cost an arm and a leg these days? Remember when you could buy a gallon of milk without needing a small loan? Yeah, those were the days. Inflation is basically when the prices of goods and services go up over time. Your dollar just doesn't stretch as far as it used to. It's like your money is slowly deflating, like a sad balloon after a party. And while a little inflation is normal, too much can be a real buzzkill. So, what does this have to do with interest rates? Well, get ready for it because this is where things get really interesting. Remember how we said interest is the price of money? Well, when interest rates are low, borrowing money becomes super cheap. It's like everything's on sale. So, naturally, people and businesses tend to borrow more. Think about it. When those mortgage rates are low, suddenly that McMansion with the golden toilet doesn't seem so out of reach. And businesses? They're more likely to take out loans to expand, hire more people, and invest in new things. All this borrowing and spending sounds great, right? Well, hold your horses because there's always a catch. Section 4. Remember when houses were affordable? Spoiler, they weren't. The idea that homes were once within everyone's reach is a nostalgic myth. Sure, prices were lower, but so were wages and the cost of living was different. Remember the 2008 housing crisis? It was a time when the housing market collapsed, leaving many families in financial ruin. Yeah, not exactly a fun time. People lost their homes, their savings, and their sense of security. It was a period marked by stress and uncertainty. Well, guess what played a big role in that whole mess? It wasn't just bad luck or poor financial decisions by individuals. You guessed it, low interest rates. The central banks had slashed rates to stimulate the economy, making borrowing cheaper. See, when those rates dropped, everyone and their grandma jumped into the housing market. It seemed like the perfect time to buy a home, with low monthly payments and easy credit. Suddenly people were qualifying for mortgages they couldn't really afford. Banks were handing out loans like candy, without much regard for whether borrowers could actually pay them back. Demand for houses skyrocketed and prices went through the roof. Everyone wanted a piece of the action, driving prices higher and higher. It was like a game of musical chairs, and when the music stopped, a lot of people were left standing without a chair. The market crashed, and those who had overextended themselves were hit the hardest. This, my friends, is a classic example of how cutting interest rates to boost the economy can sometimes backfire. While the intention was to make borrowing easier and stimulate growth, it led to a bubble that eventually burst, causing widespread economic pain. The aftermath was devastating. Families had to pack up and leave their homes, moving into rentals or even becoming homeless. The dream of homeownership turned into a nightmare for many. Communities came together to support each other, but the scars of the crisis remained. It was a harsh lesson in the dangers of easy credit and the importance of financial responsibility. Over time, the economy began to recover, and new housing developments sprang up. But the memory of the crisis lingered, a reminder of what can happen when the housing market gets out of control. Today, we still see the effects of that period. Housing prices continue to fluctuate, and the lessons learned from the 2008 crisis influence how we approach the market now. It's a complex dance of supply, demand, and financial policy. So while the idea of affordable housing may seem like a distant dream, it's important to remember the past and learn from it. By understanding the factors that led to the crisis, we can work towards a more stable and sustainable housing market for everyone. Section 5. The referee in the money game. Enter the central banks. These institutions are the unsung heroes of the financial world, often working behind the scenes to ensure economic stability. These guys are like the referees of the economic game. Just as a referee ensures fair play and adherence to the rules in sports, central banks oversee the financial system, making sure everything runs smoothly. They set interest rates, trying to find that sweet spot where the economy is growing at a healthy pace, but not so fast that it spins out of control and crashes into a wall of inflation. This involves a lot of data analysis, forecasting, and sometimes even a bit of guesswork. It's a delicate balancing act, like trying to juggle chainsaws while riding a unicycle on a tightrope. One wrong move and the consequences can be disastrous. They have to consider various factors like employment rates, consumer spending, and global economic trends. Sometimes they lower interest rates to encourage borrowing and spending. This can help stimulate the economy during slow periods, making it easier for businesses to invest and for consumers to buy homes, cars, and other big-ticket items. Other times, they raise rates to cool things down when the economy gets too hot. This can help prevent inflation from spiraling out of control, but it also means higher borrowing costs for everyone. Basically, they're trying to keep everything from going completely haywire. It's a tough job, requiring a deep understanding of both domestic and international economic conditions. Because trust me, nobody wants to see what happens when the economy goes full-on dumpster fire. The repercussions can be severe, affecting everything from job security to the value of our savings. Central banks play a crucial role in preventing such scenarios, making them indispensable in the money game. Section 6. A balancing act. So we've established that cutting interest rates can lead to more borrowing, more spending, and potentially more inflation. But it's not always that simple. Remember, the economy is a complex beast. There are a lot of factors at play. Sometimes inflation is caused by things completely unrelated to interest rates, like supply chain disruptions or a sudden surge in demand for certain goods. And sometimes, central banks cut interest rates because they're worried about a recession and they're willing to risk a little inflation to avoid a bigger economic downturn. It's all about finding that balance, folks. Section 7. So what now? The bottom line is this. Interest rates and inflation are connected. When interest rates go down, it can lead to inflation. But it's not always a one-to-one relationship. The economy is complicated. So, next time you hear about interest rate cuts, don't panic, just remember that it's a balancing act. If you like this video, please share it with your friends, hit the like button, subscribe to the channel, and watch more of our great videos. Thanks for watching!